The second part, trading by technical analysis. Fundamental analysis. Fundamental analysis is a method of evaluating securities by analyzing the financial and economic fundamentals of a company or an asset. The goal of fundamental analysis is to determine the intrinsic value of a security and compare it to its current market price. By doing so, it aims to identify undervalued or overvalued securities that could be potential investment opportunities. One of the key components of fundamental analysis is analyzing a company's financials. This includes looking at the company's income statement, balance sheet, and cash flow statement. Analysts will use this information to assess the company's financial performance and to identify potential red flags. The financials will also help to determine a company's growth prospects and its ability to generate cash flow and profits. Another important aspect of fundamental analysis is analyzing a company's management. This includes evaluating the management's experience, track record, and the company's corporate governance. A strong management team is crucial for a company's long-term success, and evaluating the management can help identify potential risks. Once the financials and management have been analyzed, the next step is to use this information to determine the intrinsic value of a security. This can be done using various methods, such as the discounted cash flow (DCF) model, which estimates the future cash flow of a company and discounts it to its present value. Once the intrinsic value is determined, it can be compared to the current market price to identify undervalued or overvalued securities. If a stock is trading below its intrinsic value, it could be considered undervalued and a potential buying opportunity. Overall, fundamental analysis is a valuable tool for identifying undervalued stocks or assets. By analyzing a company's financials and management, it aims to determine the intrinsic value of a security and compare it to its current market price. This can help investors identify potential investment opportunities and make informed decisions about buying or selling securities. Versus risk management. Risk management is an essential aspect of trading and investing. It involves identifying and assessing the potential risks involved in a trade or investment and taking steps to minimize or mitigate those risks. There are several types of risk that investors and traders need to be aware of. Market risk is the risk that an investment's value will decrease due to market conditions. Credit risk is the risk that a borrower will default on a debt. Volatility risk is the risk that the value of an investment will fluctuate rapidly. Each type of risk requires a different approach to management. One of the most important tools for managing risk is setting stop losses. A stop loss is an order that is placed with a broker to sell a security when it reaches a certain price. This is used to limit the potential loss on a trade. By setting stop losses, traders and investors can limit their potential losses and protect their capital. Another important aspect of risk management is proper position sizing. Position sizing is the process of determining the appropriate number of shares or contracts to buy or sell based on the size of your account and your risk tolerance. By properly sizing your positions, you can ensure that a single losing trade will not significantly impact your overall account balance. Finally, it's important to have a risk management plan in place. This plan should include strategies for identifying and assessing risks, as well as methods for managing and mitigating those risks. This plan should also include a process for regularly reviewing and adjusting the plan as needed. In summary, risk management is a crucial aspect of trading and investing. By identifying and assessing different types of risk, setting stop losses, using proper position sizing and having a risk management plan in place, traders and investors can protect their capital and increase their chances of success in the market. Putting it all together. Technical and fundamental analysis are two important tools for making informed trading decisions. When used together, they can provide a more complete picture of the market and help traders and investors make more informed decisions. Technical analysis can be used to identify trends and potential trade signals, while fundamental analysis provides a deeper understanding of a company's financial and economic fundamentals. By combining the two approaches, traders and investors can make more informed decisions about buying or selling securities. Having a trading or investing plan is also crucial for success in the market. This plan should include your overall investment goals, your risk tolerance, and the strategies you plan to use to achieve those goals. A plan can help you stay focused and disciplined, even when market conditions are uncertain. Staying disciplined and avoiding emotional reactions is also key to success in the market. Emotional decisions can often lead to poor outcomes, so it's important to have a plan and stick to it. This requires patience, discipline, and the ability to avoid making impulsive decisions based on short-term market movements. In conclusion, combining technical and fundamental analysis, having a trading or investing plan, and staying disciplined and avoiding emotional reactions are important steps to increase the chances of success in the market. By using these tools and strategies, traders and investors can make informed decisions and achieve their investment goals. 7. Conclusion. In this guide, we've covered the key elements of market analysis, including technical analysis, fundamental analysis, and risk management. We've also discussed the importance of combining these tools and strategies, as well as the importance of having a plan and staying disciplined. It's important to remember that market analysis is an ongoing process that requires ongoing education and improvement. There is always more to learn, and new tools and strategies are constantly being developed. Keeping up to date with the latest developments in the market is essential for success as a trader or investor. In conclusion, market analysis is a critical component of successful trading and investing. By understanding the market, using technical and fundamental analysis, managing risk, and staying disciplined, traders and investors can increase their chances of success in the market. Ongoing education and improvement are also important components of success, and traders and investors should never stop learning and seeking new ways to improve their skills and knowledge.